gross domestic product. So whenever this gross domestic product is about to be announced in the market, you see the market condition, it gets a little bit nervous, and you see it reflecting in the stock prices as volatile. If the GDP numbers turn out to be positive with respect to the previous fiscal year or the previous quarter, then you see the bulls charging up and the market starts to boom. And the GDP numbers turn out to be disappointing on the negative side, then the bears charging and the market starts dwindling down. The same situation happened during the pandemic. GDP numbers turned negative, market came down. GDP numbers went up after few quarters, markets went up. And then the same situation occurred even in 2009. In 2009, although the GDP numbers were not negative, but compared to the previous year, the performance was actually negative. So hence, because of GDP numbers, the market came down during 2009 as well. And subsequent quarters, once the GDP showed signs of improvement, then the market came up. How important is the GDP is, right? To decide whether the market should come down or no. Fantastic. So what is the GDP finally? Gross domestic product. So when you say gross, it's the total income received by all the participants within the economy. When we say gross salary, the gross salary is the total income which every person receives in hand without considering any interest which are being incurred, any expenses or any taxes which are being considered on the income. Without considering any of those aspects, the total income which the person gets is called as gross. The same consideration is given to gross in case of a gross domestic product. Now to get income, somebody has to spend. So we could also consider the total spends done by all the participating groups of the economy. By the way, who are these participating groups? The participating groups include the private organizations, include the government bodies, include people like us, who are consuming chips and washing machines, buying the stuff. We are spending, so we are contributing towards the GDP. And then finally, us, including the government body as well as the private organization, they also collectively contribute towards exports of goods and services to a broad market. And they also do import of goods and services from abroad. And the difference between these two, the difference between the export and the import, the net value is considered towards the calculation of the gross domestic product. So now that we have understood what is gross domestic, let us see what is product. So product, as I have already indicated a few minutes ago, it's a combination of goods and services where all the participants of the economy contribute towards GDP growth. So if the GDP turns out to be positive, then the government decides whether should they control expenditure, increase interest rates or no. These are the decisions that the government takes. And the private organization, they take a decision whether should they continue spending, improve the infrastructure, continue building assets, or wait for a situation to come to invest their capital to build assets. So these are the decisions which GDP helps towards the government as well as the private organization. So it should help us as well in taking our investment decision. See you.